Well, I'm sure. Yeah, sounds like you got a lot of things figured out. Okay, so let's get started. If anyone else trickles in, I'll just add them to the conversation. But just wanted to kick things off here. I think just to introduce Hemal. I think if for those of you who've taken kind of my real estate class, I've mentioned him, multiple times. He's a friend. He's a mentor to me. How we met was actually a few years ago. We were going through the same coaching program, business and performance coach. His name's Jason Dries coaching, really great coach. And that's how I met Hemal. And he was kind of a standout kind of superstar in the group. And then also a couple of years ago, Hemal introduced me to GoBundance, which is kind of a real estate mastermind that I've talked about. So I've just been really thankful to have connected kind of by chance with Hemal over the years, but he's really guided me along the way for my personal real estate investing journey, and has really just been just a really nice guiding light. And so I wanted to bring him to this conversation, to this group effectively, because we're all here about learning. I think I mentioned to you, Hemal, that this audience is some newbie investors, some people who haven't taken that first step, to some people who have a small portfolio and they're trying to take it to the next level. And I figured, why not bring Hemal to this group, who is an experienced operator. You've built up a pretty amazing portfolio over the last few years, over 1,000 units, multifamily, also new development as well. And I figured that you could give us a good primer on multifamily and kind of what it takes to succeed in that space and build up a portfolio. And I've mentioned this to folks in the class too, that I personally am really bullish on the Southeast region. I think Atlanta, the Carolinas, which is where you focus your team's efforts on. I really think that those areas have a lot of growth potential. And that's another reason why I thought you'd be a great speaker for this group. So the last thing I'll say is I really appreciated Hemal. He's been super generous with his time over the years as well. I kind of talked about how he's been a great mentor to me, but I think if folks do decide to invest with a GP, I've seen some folks who kind of they'll take the money effectively and I'm sure they'll invest it and do well, but they're a little bit more hands off in terms of the LPs that they work with. Versus I found that Hemal is just very generous with his time, very willing to answer questions and make it a very educational experience for potential LPs as well. So that's a little primer, a little thing to kind of kick off the conversation with Hemal, but maybe I'll let you give a little bit of an introductory kind of remark to the group, and then we'll kind of dive into some of these questions. Oh, and then the last thing I'll say too is we're hoping, similar to other conversations, just to keep this just really casual. If folks have questions, feel free to chat them or unmute and speak up as well. So we're going to spend maybe 30-40 minutes just talking about multifamily in general. And Hemal has a deal that he actually wanted to walk us through as well. A lot of folks had kind of messaged me on this side and said, hey, can we talk specifically about a deal and do a deep dive on it? So we'll be spending some time on that too.
Yeah, well, thank you, Cliff, for that introduction. You're very generous with your words and kind with your words, and the feeling is mutual. I learn from you every time we speak as well, so appreciate that. Good morning, good afternoon, everyone. Thanks for the investment of your time. I know, middle of the week is busy for everyone, so I'll keep my introduction short. I've been there in your shoes. I was in the corporate world, management consulting with Accenture for about 15 years, and from analyst to managing director across 3 continents, worked with everybody from Disney theme parks to the Vatican. Traveled across the world on a weekly basis. I lived out of my suitcase. Then I had my twin babies, decided to hang up my traveling boots, entered the financial world. So I was senior vice president with Wells Fargo. And that's when I kind of introspected on what is my core competency and what I really like doing versus, figuring out multiple things. So that led me to a tested journey of multiple businesses that I scaled and exited. Outsourcing company, lending firm, residential real estate company, before we started Exponential Equity in the heart of COVID. And, really, I'll tell you why deal economics and multifamily from our perspective, from a long-term philosophy perspective, worked, and why we are so bullish on it. So yeah, that's kind of my journey. We are, to Cliff's point, we're a firm that's 13 people strong now, within 26 months, which is insane. 150 million in assets under management and development, plus about 600 acres of land projects that we are working on. And then we're expanding into a couple of things that I can touch on if there's some time. But yeah, that's my introduction. Cliff, I'll hand it over to you.
Okay, yeah, so let's start to maybe tick through some of these questions. And as I mentioned, if folks have questions, feel free to just chime in or chat them over. But yeah, just to kickstart, maybe if you could give us a little bit of just what is real estate syndication? And then when someone invests in it, what does it mean? What are some of the risks? What are the potential rewards? Why do people consider real estate syndication?
Yep, that's a great question. So in its simplest form, it's pulling together money and sweat equity to buy a real estate project, mostly commercial, or any project. It could be a business as well, that you could syndicate. And essentially, syndication is a group or pool, right? So in its heart of it, one group is coming up with mostly the money side of the equation. The other group is coming out with the time side of the equation and the resource side of the equation and competency side of the equation. And they join forces, they buy an asset to do something with it, ideally generate a lot of profit out of it from a business plan perspective, and and execute on that plan and split up the profits in some fashion, right? That's the essence of it. The risk when it comes to real estate syndication, the reward is, a lot of people do single family rental properties, STR properties, which are great cash flowing components. But when you do the two things with them is sometimes they can suck up your time, especially if there's a scalable entity. If you have 1Z, 2Z properties that you're renting out, great tenants, typically you don't get too many phone calls. But if you go to 10, 20 properties, your debt side of the equation has constraints. You can only buy 10 rentals. Your times, resources are finite when you're doing a full-time job, you have family with kids, etc. So this syndication process, especially from an investment standpoint, allows you to come with a capital side of the equation and take your hands off, right? So the way that the legal side is structured is, as a passive investor, you are not having any tenants or toilets responsibility, any risk associated with the loan or executing the business plan. You don't have to share your financials from that standpoint. The only thing that you're bringing to the table is the capital side of the equation, right? So it's like almost buying a share. The risk side is obviously you're losing control, right? You're at the mercy of management team and their decisions because they have full discretion, right? You're at the mercy of the macroeconomic environment. You can't step in and say, well, I need $50,000 right now, let me sell my shares, right? It's illiquid from an investment standpoint. So you have to have a longer term horizon. And there's always risk associated with any investment that you do. If anyone tells you otherwise and 100% guarantees something, run fast, right? There's always an inherent risk that if you do things 100 times, 5 of the times, you might lose some money or you might have below average returns. 5 of the times or 10 of the times, you might have above average returns. And the other majority of the times, if you are with a good operator with good conservative projections, you will over a long period of time be on the safe side and generate 15 to 20% returns, which we typically see in a real estate syndication.
Yeah, and maybe to add to that, I don't know if you have some thoughts on like a stock, like a REIT versus a real estate syndication, but my general sense has been REITs kind of going back to the liquidity that you talked about. There's more liquidity and it's good if you want to diversify into real estate. More power to you. I think it's still a good option, but I've typically seen that syndications, the returns can be a little bit higher because of the illiquidity premium, but also I think there's more, it's more of a nuanced, like a deal hunting and more project specific than a REIT.
Yeah, so there's 3 entities. That's a great point. There's 3 entities. You have a joint venture entity. So 4 friends came together and bought a business. Every one of them has to have some management responsibility personal guarantee or some non-recourse guarantee on the lending side. Ideally, if you're not doing that, you're actually syndicating. So that's a joint venture, right? Everybody's responsibility, everybody's chipping in with both their time and money, and working on it. You are a partner in the firm. That's one side. The other side is the REIT structure, which is you're buying shares into a company that then invests into real estate. So the shares are liquid to a certain extent, but you're not buying directly into the asset, you're actually buying shares into the company. So the real estate syndication structure allows you to have best of both worlds. You get a partnership structure, just like the joint venture agreement, in the sense that you will get a K1 directly from the asset, and allows you to take depreciation losses and other advantages to that from a tax structure standpoint, while also, just like the REIT, you're investing passively versus the active structure that a joint venture has. So it ties both of those structures together, gives you the best of both worlds.
Okay, cool. Maybe that's a good segue into kind of the next couple questions, which is, you hear this term a lot about accredited investors, and I think a lot of real estate syndications require that. What does that mean? And then maybe we could also brush upon the 506B versus 506C deals, which are two different, I think, structures of or fundraising ways.
Yep, I'll touch on the B versus C and then jump into the accredited one. So think about, when we structure a legal document for a real estate syndication called a private placement memorandum, it's essentially almost like going through an IPO process, right? So if you go through a typical IPO process and provide some offering of securities, it takes you millions of dollars typically, with a lot of paperwork, with road shows and other requirements from a due diligence standpoint, regulation standpoint. That is just for a small, even a $10 million, $20 million asset, it just doesn't make sense. So the SEC, Securities and Exchange Commission, provided an exemption to that called Reg D, Regulation D, and it had, before the Facebooks of the world, it had only one stipulation, the 506B. Now they've categorized it into B and C. So the 506B is the 80 to 90% of the private placement syndications that happen even now. And even though that you see a lot of stuff kind of advertised on the internet, most of the deals are shaking of the hands, sitting in a country club and, gathering the money. It's essentially, you have to have a pre-existing relationship with the person who's investing. And it could be a couple of phone calls. It could, you have to know the person a little bit before you, or anyone in the management team that is a partner in the process needs to know that person that is investing. The second thing about the 506B is you cannot advertise that deal to any strangers and cannot offer any securities there. So our 506B deals, you won't see us talking about them until we close them. We can say we closed on this asset. Otherwise, we cannot advertise those assets to people on Facebook or Instagram or anything of that sort. The last thing is the 506B accepts both accredited and non-accredited investor, and I'll go into that. And there is no more, even if they accept the accredited investor, there's not a stringent check from a third party perspective that I'll go into details in a 506B deal. 506C is opposite of that. You can advertise, you can bring any stranger into the project, as long as they've done the due diligence, obviously. And but it only accepts the accredited investor category. So what is an accredited investor? This is kind of an arbitrary number that SEC said. If you as a single person earn $200,000 or more in the last 2 years, or as a married couple own $300,000 more in the last couple of years, or have a net worth of $1 million outside of your home, personal residence, then along with some other requirements, you can take now series FINRA certifications to become an accredited investor. Then you are classified as an accredited investor. And that's for the sole purpose to say some of these deals can be complicated, right? At the end of the day, you're relying on the operator but you also are doing some level of due diligence to ensure that your hard-earned money is placed in safe hands. And so the SEC's definition of who is savvy enough to invest in these type of projects, real estate or otherwise, that's their arbitrary line that says people above this line are savvy, and those are the only ones that can invest in these types of projects. So that's the accredited investor definition. And for 506C deals, you have to go through a third-party verification one time with every operator, so that we stay compliant from an SEC standpoint. And that's a certificate from your CPA, or there are third-party websites that have attorneys for hire that would look at your net worth statement or your income statement, W-2, and kind of give you a certificate that says this person is an accredited investor. Once you invest with us one time as an accredited investor, I don't need that certificate for the next 5 years. So that's, pain in the neck process, but one-time process, keeps everyone compliant, and that's how it is.
Gotcha. Yeah, I recall, I mean, I know that SEC is pretty strict on that. I remember I went to a real estate conference a few years ago. It was a multifamily kind of boot camp. And I remember one of the syndicators there was having everyone like fill out like a business card with your name and contact info.
Yeah.
And that was related to it being it was probably a 506B offering. And he wanted to make sure he had record keeping of the contact point and all that. So in hindsight, I realize now what they were doing. Smart to have record keeping, but I didn't realize it at the time. I thought it was kind of funny that everyone had to fill out a card to talk to this person. Cool. Yeah, thanks for sharing that. Maybe we could jump into the next question of the Southeast region, the Carolinas. I know you live in Charlotte, but I think for a lot of this audience here, most of them are not in Charlotte. I don't think anyone here is from Charlotte. So maybe share a little bit about like why do you think that region is ripe for real estate investing and a good area?
Yeah. Now there's several factors, but I'll go through a couple of them, right? So if you open the US map and look at Charlotte and kind of draw a 3-hour circle around that, you've got Raleigh, North Carolina, Winston-Salem, Greensboro, Asheville, North Carolina, Wilmington on the beach side, Greenville, South Carolina, Columbia, South Carolina, Spartanburg, South Carolina, Charleston, South Carolina, Myrtle Beach, South Carolina. Essentially 8 to 10 unbelievable markets that my team can drive to and understand the sub-markets, right? So real estate, if you go beyond the way you typically, if you're either a long-term, when you invest in stock or other asset classes, you're either I'm going to invest in the index funds with my 401k and live out the 20-30 years, or you do short-term investing. And if you experience short-term investing, you on an average, you don't come nicely, right? The house always wins. So if you take that same model from a fundamentals of the US economy standpoint, right, you got to figure out beyond the short-term headwinds and tailwinds we'll talk about in the next line item. If you think about, we are 5 million homes short in general in the United States. The construction industry right now is facing, some barriers to building, and the markets like Texas and Carolinas is where the job growth is getting there, right? So North Carolina is one of the only purple states from a political standpoint, one of the few, I would say, right? The governor is Democrat, the Congress is Republican, so they do a lot more joint venturing of ideas that used to be the norm. As an example, that leads to a lot of laws that are business savvy. Came as the #1 state from a business standpoint to invest a couple of months back. And so there's just many people fundamentally moving there, many manufacturing regions. If you think about globalization, pendulum kind of swinging to more natural nationalism in terms of manufacturing, right? BMW, for example, announced their battery plant to be in Spartanburg, where we're buying the asset, which we'll talk about. There's just a corridor of highway across from Greensboro to Greenville, that 4-hour strip. And that's where our bet is, because every lane there, if you drive there, is being expanded. Every other place has a manufacturing facility, industrial facility. All that requires this core asset of multifamily. It doesn't go away in COVID like hotels do or office buildings do. People gotta live, people have to move somewhere, and they have to move somewhere that's relatively affordable. And that's why the Carolinas, in my mind, the next decade or two are just gonna keep on booming and booming in terms of growth.
Yeah, I think, yeah, what for me, just to add to that a little bit, as kind of a naive, I guess, California person that spends all of my time in California, Charlotte reminded me, like, I think a lot of people on this call probably have been to Austin. And when you go to Austin, there's a palpable sense of just like growth. There's an energy in that city. My first trip out to Charlotte 3 or 4 years ago, similar sense, like you could just tell there a lot of good things were happening there. I remember seeing a lot of cranes, a lot of development. And it was just very eye-opening because I hadn't really spent much time in that area. Like you brought up Charleston, Asheville. Those areas are considered some of the best short-term Airbnb markets as well. But most people, I think, like in California, haven't really been out there before, so they don't really know what that's like. But it is very eye-opening to just kind of see the population and job growth in those regions, so in those areas.
Yeah, 250 people are moving to Charlotte every day. It didn't see any housing recession in 2008. And we just attended last month a multifamily, not master plan community conference. So these are the biggest players in the real estate world that are building, 30,000 acres type of communities with 2 lagoons and built to rent and university research centers in the middle, 10 years, 10 phase type of projects. And even when they had categorized cities in where they want to put bets in over the next 5 years in this market, and you had your Phoenixes of the world and even Dallas where the inventories were rising, guess what? Charlotte on the right side. Inventory is still tight. People are still moving. It's going to remain like that for the foreseeable future just because of the growth it experiences.
Yeah, and for a lot of the people on this call who like were part of the real estate class that I teach, we talk a lot about market selection. And I just feel like market selection it's one of the most important pieces, because you can manage a property well, but if the market is not growing and doing well, then it's hard for the investment to do well. Like I've shared with people on this call, like the 20 unit in Charlotte that we sold, last month, ended up doing pretty well. And I'll be the first to tell you, I don't think we managed it all that well. We were probably just average managers, but because the market was doing so well and so hot, we made out pretty well on that. So
that's such a great point. In my mind, any mistake, big or small, in real estate investment can be corrected over a period of time. You can come out stronger if you ride the market cycle right, provided it's in the right market. Even before pricing, even before any other fundamentals, the right sub-market, the right street, knowledge of that is just primary.
Agreed. Yeah. I think this next question, top of mind for a lot of folks. How's your team? How are you thinking about economic headwinds? There's so much talk about recession. People saying that the real estate market, I don't think many people are saying it's going to crash, but it sounds like there's a correction that's in process or on the way. How are you kind of thinking about all that as you're potentially acquiring more properties and just, I don't know, repositioning things? Any kind of general thoughts on that?
Yeah. I would say, first of all, understand a little bit more granular structure on all these things and don't generalize what the news says, right? And what I mean by that, what Nassim Taleb says typically is, you don't want to go into a river that is on an average 4 feet deep. There will be some places which are 10 feet, right? So single family, if you think about debt just in general, there is the Fed funds rate, there is the agency, so Fannie Mae, Freddie Mac rate, which is based on your 10 years treasury curve, forward curve, and current yield. There is, the rate, which is the floating rate, which is SOFR based, so secured overnight funding rate, which used to be LIBOR, which is where the CLE market and all the debt funds, etc., kind of go in. So there is different debt. There's CMBS debt. There's different debt for single family versus commercial structures, especially multifamily. There's different players who are trying to enter and buy their first house, and the affordability that comes with us versus 20,000 families moving in the next year in a sub-market where there is no place to buy, or if there's a place to buy, the affordability is so low that they have no choice to rent, but to rent and to find the right place, which is still relatively affordable. Those are two different conversations. So while single family inventory would increase somewhat because of affordability, the supply side construction is slowing down. Supply side is getting tighter and tighter. So the problem over a long period of time would exacerbate, in our opinion. And multifamily still, because of the low inventory there is, sellers haven't come out and come down in prices from our vantage point. So it's harder actually to find a good project right now because your debt service or your mortgage payment is a little higher than, or significantly higher than what it was 12 months back. But the seller might be looking at the same price they wanted a few months back. And slowly and steadily now we are negotiating with the seller. We just got a whooping 8% discount on a $24 million deal from the seller. We're like, hey guys, even though our interest rates hasn't moved, just like I explained, from a commercial standpoint, the SOFR rate hasn't moved much in the last couple of months from where we look at it. But because we can show, hey, mortgage rates have gone from 3 to 7%, we are scared. We don't want to. We would like you to come up with a discount, right? So we can negotiate those kinds of things and make it even a better deal. But at the end of the day, the math is the math. If you can meet your mortgage payment, if you can generate 5 to 8% cash on cash return, you're buying in an area that over the next 5 years, 10 years, long term makes fundamental sense because of the growth around it. In general, you would do very well once the market cycle comes back. And 9 out of 10 recessionary times they have come back. So that's our bet is, at some point, we don't know, we don't want to bet on the Fed coming back in 12 months or 6 months or 18 months. They can take however longer it has. It will create short-term pain for people who have less cash flow. Generally, the Class C apartments would get more painful from an investment standpoint. But the newer stuff, people who have 100,000+ in salary, those guys will be okay. They might spend less in the discretionary items of things, but they will still be able to afford, for the most part, the rents that we are looking at, especially in the Carolinas market. These are not, $3,000, $4,000, $5,000 in rents. These are still relatively $2,000 or below in terms of rents for the most part.
Yeah, I really like what you said there, because it's reminding me that real estate is very hyper local, something to invest in. And I think you see the headlines in the news, prices coming down X%. But you're right. I think, like, for example, like in the Midwest, I think in the 07 to 09 time had a lot less fluctuation than the coastal cities, and it becomes a much more localized conversation. And also, I think what you mentioned of like taking a long-term view on debt service and all of that is important, because as long as you can kind of ride the ups and downs over time, I think real estate generally has been a pretty good asset class to invest in. Yeah,
we will be extremely assertive with lowballing offers in this volatile environment. And as long as we get discounted deals that we know that work fundamentally right now with 8% interest rates, they would work amazingly when their interest rates go back to 5%, right? And that's the leverage we want to use. So, but we don't have to say that. Every seller we go to and say, hey, this 8% could be 12%. We don't talk about how we fix that 8%. We are going to buy the deal as if it's going to be 12%. So we're going to lowball all the offers. And this is the best time from our perspective. And there are a lot of players that will put pencils down to really shop around. We don't have any numbers fixed to move the machine. We have multiple businesses and a diversified portfolio. So if you buy 3 projects or 1 project or 6 projects in the next year, it fundamentally doesn't change the discipline we have as a company on how we want to pursue acquisitions.
Interesting. Okay, so you're saying, in other words, that like during this time, you're effectively trying to fit the deal into the buy box criteria. Yeah. And you submit the offer. It's a lowball offer, but you might be the only person that they're talking with. So they might say, take a hike, but some people might engage. And those are the ones who are effectively negotiating it to a great deal in this climate. And then you always can refi down the road. You're just making sure that there's some safety margin there.
Exactly. And we can be aggressive once they accept our low ball offer, right? Everybody else would go back to 30-day, 60-day due diligence period. We're okay putting hard money down day one. Again, because that we know our submarkets. We know our deal. We are developers ourselves. So when we know what it takes to build a new rental community, we know what it takes to buy one. So we're very confident with the numbers once we get the deal.
Gotcha. Okay, cool. This question wasn't on here, but I thought maybe this could be a good one for the group to hear is like, maybe if you can share a little bit about like your team. I know you had mentioned 13 strong. What did that look like, the evolution of the team? And then also maybe if you can share a little bit about, I don't know, what is your one tip or a couple tips to folks of like shift in mindset to get to 1,000 units? You know, I think about my real estate journey going from 0 to 70, or I guess now we have 50, but that took some shift in mindset, but I definitely don't have the same mindset of someone who has 1,000 units. What can you say kind of about the mindset piece of it too, along with kind of your building your team over the years?
Yeah, absolutely. I'll talk about the team. It's all them. I come to these conversations, right? That's all. Well, so the team is divided with 13 people. It's divided into 3 divisions. We have a land division. Like I mentioned, we have 600 acres of land in different stages of rezoning and entitlement. Again, our strategic partnership with the mayors of the county, the council people. We sit in economic development meetings to understand the next 5-year plans in different zones around the Charlotte area. And that allows us to understand where the path of progress is, where the city is going to invest next in terms of roads and other things. So we want to buy land there at a very low cost basis, farmers, agricultural land, and then rezone it into multifamily or townhomes, etc. And generally just triples the value of the land from that perspective. So we have a very small set of investors that come alongside with us on the land projects. Most of the land projects then will sell to national developers who are building big communities. Some of them we keep. That's the second division, which is a construction division. And we have about 85 million in construction going on, 4 projects across the Charlotte MSA. Built to rent community, built to sell, self-storage, and 144 units multifamily. And then we have the existing acquisitions business where we have, the overall, I'm the CEO, my partner Yomesh is the CEO across the 3 divisions. The land, we have 2 land guys who are retired land guys from other national developers. They develop 8,000 lots. So they navigate the bureaucracy of all the council members and, shaking hands and all of that, understanding what the concerns are as per growth. We have a head of new development, Brandon, was our third partner. He had his own residential development firm. He and I connected very coincidentally, and over a couple of beers one evening, he got so inspired by the vision I had on creating a company. He actually was like, I'll sell my real estate company and join you as head of new development. So he sold his residential company, but he brings tremendous amount of expertise in the construction side. We have a director of asset management, director of acquisitions, marketing coordinator, underwriting analyst, construction manager, property manager, etc. So we're building. The first layer was just the leadership of acquisition, asset management, construction. And then the next layer was get the land guys in, construction manager, property manager in. The third layer is to build the horizontal. So we just hired an executive assistant. We'll get into more horizontal lines. If you think about a Fortune 100 company, right, you have your vertical divisions, but then you have the support structure with HR, accounting, IT, infrastructure. So you've got an office now and all the other stuff are being in place. So that's kind of the team. When it comes to scaling, I think the 2 biggest piece one should keep in mind, right? One, really introspect which lane do you want to be. The reason I'm successful almost always is I know what I like to do and what I don't like to do. And what I like to do is the growth of the company, the investor relations, the conversations I have with partners and the debt side and lenders. And all that strategic relationship that allows us to be scalable. But I'm not the guy who looks at the contracts. I'm not the guy who understands construction, to be honest. And to have the comfort to hire rock stars or partner with rock stars to kind of build that around you is one. And the second thing is, I always say this is 100% of 10 million and 1% of the billion is the same thing, right? In terms of net worth or where you want to be. But if you create an organization that's complex, you have to put a lot more time into the culture building, the processes, the systems, versus you be lean and mean with a couple of people. And you really need to understand where you want to be and who else you need. Again, do you need a CEO to kind of help you scale that or not? A lot of people talk about this book, Who Not How. That's been my philosophy organically. If I want to grow a division of the business, I'll find first the CEO or the operator that can run that business well, brings that 10, 20 years of expertise. So I don't have to go into learning way and trial and error, and especially with investors' money, right? It was my money, I can risk it from a trial and error perspective, but from an investor standpoint, I want to make sure every deal we do is a unicorn. So I bring that CEO into the fold first, and then go into building a business around them and start doing deals. So that's the begin with an end in mind. That's the way I have structured the team always.
Cool. Thanks for sharing that. Yeah, maybe we can transition to some questions and talk a little bit about the project in Spartanburg.
Yeah.
Oh, actually, I did have one. I had one question to ask you. So I'm kind of going off the script here a little bit, but I thought it was so insightful because you shared this with me a little while back about how you build inroads and connections with local brokers. You mentioned politicians as well. I thought that'd be really insightful for the group here. And maybe you don't need to share all of your secrets and everything, but that was a moment where I was like Hemel's doing it in a different way. It's one thing to search on, I don't know, LoopNet or talk to one broker and all of that stuff. I realize you're playing this game at like a whole nother level, and thinking about it in a whole nother strategy. So I don't know if you had maybe some things you can share with the group about that.
Yeah, stop being transactional, right? That's dig your well before you're thirsty, is another book that is a good one, right? With any good sales process, you want your investors, your relationships all warm, trusting, to a point where it's a second slide conversation, right? They see the second slide of your investor memorandum and they're like, yep, I'm in, I've got the money. Similarly, it's with the brokers or the politicians or the influencers in the local market. We don't go and have that usual phone call that a real estate boot camp would teach you. Hey, call your broker and say, hey, I'm working with so and so. What's your best deal available? Because guess what? They have had that 50th phone call in that week. So you have to really differentiate and really, but do that by saying, hey, I'd love to take you out for lunch. I'd love to, what do you like doing? Maybe they like cigars, steakhouses, whatever. You have to ensure that you don't dine alone. You build that relationship, talk about other things, build the relationship very strategically, then talk about the deals and projects. Whatever they throw from a first deal perspective, typically brokers want to give you like an okay deal the first time, a small one. You have to figure out how to make it work the first time around. And then they'll start providing you more projects because of your track record. Our director of acquisitions, Casey, he wines and dines the brokers consistently, whether we buy 3 projects a year, every week, every 2 weeks, he's out. I don't go there, I don't even drink. So that's not my domain. Again, we have someone who can be there at 2 a.m. with the brokers and enjoy the life, and that allows us to have initial access to the deals. Similarly with the politicians and economic folks, we are into Charlotte Business Alliance, the Charlotte Chamber of Commerce, being there, going there without any agenda, really being interested in building the rapport with the folks and showing your face, doing some awareness, doing some sponsorship. We have sponsored fashion shows now, we've sponsored events now. We're getting our community's name out there to say, this is us, we are going to be here, this is our home as Charlotte, we really want to make an impact and a difference into the community by the way of real estate, and giving back in real estate as well. And that's been the longer term view again, not trying to extract the most out of one conversation, but giving back, connecting them with the right folks, just fundamentals 101 that has been more effective.
Yeah, it's just so cool to hear, because I remember like you had a ribbon cutting ceremony, and I remember you had like I can't remember what the city was, but the mayor of that city had come by, just like stuff
for the self-storage.
Yeah, I just think that most people aren't thinking about the long-term development side and just the relationship building. So really cool to see your team do all of that. Let's maybe switch gears a little bit, because I know some people wanted to just see something like this, wanted to see what it's like to dig through like an offering memorandum. And then quickly, Aaron had a question. He said, what's the general timeline to realize a return as an LP?
Yeah, that's a great question. So it depends on the project. Typically an existing acquisition, which similar to this one, these are cash flowing day one properties, right? So again, you have to think about them as a business. If they're cash flowing day one because the rents are coming in after paying your mortgage, after paying your salaries and all the other expenses, keeping some for capital expenditure reserves, you'll have some part left. And out of that should generate some cash flow. So on a quarterly basis, we mostly provide on all our existing acquisition projects quarterly distribution to our investors, up to 7% based on an annualized basis. So $100,000 would yield $7,000 a year in terms of investment capital return back. And then typically most in syndicators or the GPs would keep an asset for 3 to 7 years. Within that time frame, they'll either sell it, and at that stage, whatever, after paying the loan, paying the broker, whatever is left, they get to split majority of the profits with the LP investors. Or if they refinanced it, which is an amazing way to do it, because you get another loan by refinancing, which allows you to have tax-free money or tax-deferred money. Then you get most of your investment, if not all of your investment back, and then the pot starts getting split up, whatever the percentage is, 70-30, 80-20, 60-40, whatever is done. That's on the existing side. For new construction, obviously you're not generating any cash flow. So typically new construction projects do not provide you quarterly returns. You're going there for a higher growth type of investment than coupon type of quarterly check that might be coming in. So new construction, whenever the construction is done, either you refinance it or sell it off. That's when you have a capital event, and that's when the profits get distributed.
Awesome. Cool. So we have about 15 minutes. Maybe Hemal, you can tell me how you want to go through this deck, and I can kind of click through for you.
I'll go through the summary and then explain, and happy to answer questions. And if that we need to reference the pitch deck for that, then we'll do that. Essentially, again, full disclaimer: this is not an offering for securities. This is educational discussion. If you're interested in investing in such assets or investments, reach out to me directly. We have our website and investment portal and legal documents and everything that you need to look over. But essentially, this is one of the projects that we bought an asset last month, 20 minutes from this one. We're building a similar size build to rent community 35 minutes from this one. So we know what it costs from a BTR perspective. Build to rent is also known as horizontal multifamily. It gives you the best of both worlds, where you have an apartment community type of feeling in terms of running it. So you have one property manager, one lease-up agent, one maintenance person across the 198 homes that we have here, but it's also deeded separately. So it's essentially you buying 100 homes portfolio, right? So if push comes to shove, as an exit strategy or flexibility, you can sell these assets individually as well. And that's why the big hedge funds like Blackstone really, really love this asset class, which came about in 2012. So this one is a 2022, so absolute brand new, fresh paint, 3-bedroom, 2-bath, 1-car garage, built to rent community, on the cusp of two highways, Highway 85, which is where I talked about the industrial growth that's happening, and then Highway 26, which is another interstate that leads you to Asheville, etc. They finished the first duplex in March of 22. They started renting things out even while there were construction trucks and things. So they rented out initially at $13.95. Then they pushed rents to $16.95, a couple of them $17.95 and $18.95, which is low rents if you look at the comps. They also didn't charge any ancillary income. So if you think about every dollar in the commercial space, if you've understood how residential versus commercial investments work, just from an education standpoint, right? Residential investment, if you have your house and you decide to fancy it out in your backyard with a swimming pool and a grotto and a grill and everything, if your house is worth $2 million, it's not going to go to $4 million unless your neighborhood kind of rises up in value as well, because you're appraised based on your neighbors. Commercial world, I'm putting this very simplistically, the commercial world, including multifamily or any warehouses or office buildings or hotels, whatever commercial properties or retail centers that you buy, they're based on mostly on the what is known as the cap rate, which is the market, but also the net operating income. So how much net income is generated by this asset. So in theory, when you go and increase the income by adding rents to, or increasing rents or adding other fees like pet fees and admin fees that are typical for apartments, or decrease the expenses, your NOI, net operating income, increases, and thereby the valuation of the asset increases, all things being equal. So that's the primary goal here. We are getting a best of both worlds. So we're getting a low maintenance asset that's built in 22 with 10 years of roofing warranties and appliance warranties and all of that, but it's also cash flowing day one. So it's very stabilized, low risk, which is what's needed in this environment. And because they've leased it up very aggressively, and I'll kind of show you the lease in a couple of minutes, we'll, over the next 20 months, so 2 springs and 2 summers, we'll get more chance to get these rents to market rents, which we believe to be $19.95 based on the comparison of the area and the comps. And that's kind of the game plan. That would increase the value of the asset, and we'll be able to, in 3 years' time, our exit is to sell it. Depending on the macroeconomic condition, we might have to keep it a year or 2 more, or if we get to refinance it, this will be a phenomenal hold as well from a long-term perspective, given the area that it is in. Let me go through a couple of slides to show everyone how the investment memorandum typically looks at. So, it shows you the summary. This is the highlight. I kind of mentioned that. Oh yeah, 100% bonus depreciation. So Tax and Jobs Act in 2017 by Trump and Jared Kushner allowed you to take some of the accelerated depreciation. I won't get into too much of that given the interest of time for cost segregation. You can book 100% of that in year 1. This is a newer asset, so the total depreciation is low because most of the stuff doesn't get depreciated faster because it's new. So in theory, about $100,000 investment in this would give you around a $30,000 paper loss in this year. So, we close in 12/15, and if you could claim that as a real estate professional, if your spouse is a real estate professional, that's a nice little paper loss that you can offset your active income or passive income, depending on how you classify yourself. So that's a big thing here. Go to the next slide. Yep, these returns, again, are based on the purchase price that we had. Like I mentioned, we just negotiated and signing the significant discount on this. So these returns will be knocking it out of the park, even better than where things lie right now. But we're expecting about a 20 to 22% average annual return. That means, if we keep the asset for 5 years, effectively your 100,000 will become 200,000. That's kind of the projection. And that includes both the cash flow during the quarterly distributions that you will get from the cash flow of the property, from the rents received, and the remaining balance whenever we go to sell it and split the percentages with all the investors. Go to the next slide. Yep, timeline, we're looking to close, on or before December 10th, 15th timeline. Yep, I mentioned a lot about Spartanburg, but it's jobs galore, right? About 6 billion in investment already done in the last couple of years. If you keep flipping through the slides, people will see all the job companies that are in the area. This asset's like 3 miles from Top Golf, so all the Class A facilities are coming up, your Starbuckses and Chick-fil-A's, and that's the best indicator of a growing market, your Starbucks and Chick-fil-A, because they do way better research in macroeconomic environment than we do. Yep, this is 20-ish thousand jobs created in the last couple of years. And I think it will surpass that in the next couple of years, given the growth that it's experiencing.
Oh, I saw an article about, let's see, BMW had committed like 1.7 billion to specifically to Spartanburg, right, in the last couple of weeks.
Yeah, it's 16 miles from us, so 20 minutes from this asset. This is number 3 here on the location map. So yeah, that facility is already 170 million. They're adding 1.7 billion more in 2 facilities around that in plants. So they're building an EV factory for the batteries, and then they're going to deploy 6 electric models in the United States that will be manufactured out of this plant. So which is awesome. Yeah. All right.
Maybe I can ask a question too, Hemal, which is, what's the incentive for the developer to sell? It sounds like they were in a good spot. They could rent out the units pretty well. Sounds like they're leaving a lot of meat on the bone by selling. Any thoughts there? Like why did they sell the asset?
Yeah, so most local developers like these have a pipeline of assets going on, and development is its own risk. So the moment they develop something, they want to take some chips off the table, right? Because it's a lot of their own cash going in with recourse debt. By our existing asset acquisition is non-recourse, so it's not personally guaranteed. Most of the construction loan are recourse. So they want to sleep better, and they don't have a property management competency, to be honest. So they have a great pipeline of investments. We're actually looking at their next asset while we close this. If this goes smoothly, we would like to have a good partnership with them and keep on buying in this area. The stuff they're building is really awesome, like upper chic, what we would expect in a $500,000 house in terms of like black lighting and white cabinets and stuff. So we are excited to forge that partnership with them if we buy this, relatively smoothly, or when we buy this relatively smoothly.
I see. Maybe I see what you mean, because it's a similar question of like, why don't fix and flippers hold and rent and build their portfolio?
Exactly.
It's a different business, and they like
different business model.
Yep. We had a few questions. Oh, Justin had a comment. He said Chick-fil-A as an economic indicator makes so much sense, but I think he was kind of surprised by that. So that
you won't see a Chick-fil-A in a bad location typically.
Yeah, I mean it's just like super funny that you mentioned that, but it's like one of those things I didn't expect, but makes like a lot of sense when you think about it.
Yeah.
Samir said most of the BMW SUVs are built in Spartanburg, and they have a fantastic US delivery service where you can take it on their track there. Oh, that sounds cool.
Wow. Yeah, it's getting 10x that plant, which is insane to think about.
Wow. And then Rob said, when going into a deal like this, do you have an indication of how many other potential buyers there are?
Yeah, we do. This one, so typically this size asset should be given to like a JLL or Northmark or Newmark, the bigger Cushman Wakefield type of bigger players in terms of brokerage firms. This was given to a very small brokerage firm because the brokerage firm's owner's father was a friend of this developer. This is kind of odd. So the brokerage firm, all they did was put it in Crexie. And Crexie, typically you have players that are looking at your $3 to $5 million deals or smaller deals. So while it was marketed, the usual marketing strategy where we would have 10 or 15 more buyers on our side, similar to our size, was not present on that. So couple that with the 3 or 4 that were present that we know of, we actually did the strategy. We came similarly in price, but we said we would put day one hard money, while everybody else said no, just because we bought an asset 20 minutes from this asset and we knew how we can scale the property management resources here. And now with the discount, we're getting a much better deal.
Gotcha. Cool. I know we're almost at time, so I just wanted to check with folks. Hemal, I don't know if do you have a few more minutes, or do you have a hard stop at 10 or?
I have a few more minutes.
Okay,
I'm sure
sounds good.
people would have.
Yeah, so I think maybe like we can, I can click through this, but I know folks might need to drop off, but it sounds like we might have a few other questions too. So maybe we could stay an extra 5 minutes.
Yeah.
For anyone who wants to. Aaron said, time permitting, can Hemal discuss how he got into the business? As someone in the corporate world wanting to do what he does, it seems extremely difficult without connections capital. Did you already have a pool of investors?
Yeah, so I enjoyed a lot of credibility from my banking and management consulting world. So it was easy to have a conversation for whenever we wanted to buy our first asset. People who I relied on, friends and family mostly, said, hey, if you're putting in 100 grand, here's my 100 grand, right? And that's how we started. We actually went to a networking event for 2-3 days, learned a lot from one of our mentors, and then met a lot of upcoming operators. And we kind of got lucky in the COVID sense that a lot of operators that were up and coming didn't really, were doing great jobs, were finding amazing deals, but didn't have the capital to work with. So we said, why don't we partner with you? We'll put in our own funds for the most part, and got some foot in the door, learned from 5 different operators from a capital perspective, and incorporated their playbook and built our best practices and created our company. So that's how we got started. The initial deals were smaller, but again, in COVID times, the first asset we bought was 28,000 a door versus 240,000 a door. And so that's pretty amazing to now, and we refinanced it at 90 a door, which is, investors were amazed at the returns, and we also have them in equity in perpetuity. So those kinds of deals were available in COVID, which now are not. So for anybody who looking to start, you have to have one level of providing value to a team, right? Either bring some capital to the table to learn from someone beyond your boot camps and learning in theory, or bring the project to the table. It could be a land piece that your friend is selling and you're looking into, and you're like, hey, I can bring this to the table. I can make the connection. Can I be part of the deal and be a fly on the wall and learn from? And that's how you actually on the job training is the best way of building that competency and experience. Having someone to kind of look over you for the first couple of projects is also helpful.
Awesome. Kelly asks, can you share a bit more on the tax benefits and the 100% bonus depreciation for this year?
Yep. So 100% bonus depreciation gets phased out by the Congress. So next year will be 80%, then 60, 40, 20, and then phases out 0. The tax benefits, in short, is when you have a property, single family or multifamily, you can do a cost segregation study. And that cost segregation study allows you to accelerate some of the depreciation. The amount remains the same, but instead of the 27.5 years or 40 years for a commercial property, you're saying your appliances, your carpet, your landscaping, as an example, cannot depreciate over 40 years. It can depreciate over 5 or 7 or 15 years. And those categories allow you to front load some of your depreciation amount. And have less depreciation after the first 15 years or 5 years, especially. And the Tax and Jobs Act said whatever is categorized in that 5, 7, and 15 years, you can claim that all in one lump in the year you buy an asset, and you can claim for this year 100% of that. So in short, what it means for you is any 100,000 investment in this asset would yield, on paper, a loss of around that 30,000. We don't know the exact number until we do the study. Around that $30,000 in depreciation losses. So when you get a partnership K1 the next year for your tax returns, you can claim that $30,000 in loss. Now, if you're a W-2 income earner, you can only claim that loss against your passive income. IRS categorizes 3 categories: portfolio, passive, and active income. Your W-2 is active. You cannot merge the 3. But if you're a real estate professional or your spouse is real estate professional, then you can merge those categories together. So in theory, you can write off a $30,000 income and bring your average general income, your AGI, down, which is super helpful to a lot of people from a tax bracket perspective. So a lot of people invest with us just for those tax benefits as well.
I'll caveat for Hemal that he's not a tax professional. You should check with your CPA, but everything is aligned with my understanding of all of that too. Cool. And then maybe the last question, Jezebel, thanks for asking. And good to see you. She says, how do we stay in touch with you, Hemal? And maybe I'll let everyone know that I'm going to send out your contact info in the recap email that I sent to folks.
Perfect.
But
Awesome.
Sounds like if folks have questions, they can kind of reach out and set up some time with you.
Yeah, absolutely. Any other questions? I don't want to bore everyone with the investment here. I'm happy to go through any slide that allows you to understand what an investment looks like, what you should be looking at in general for any investment that you're looking at, or any questions in general that I can help answer.
Anyone else? I think that's it then. I'll just click through so that folks on the YouTube replay can also see all the slides too. But okay, cool.
Awesome.
Well, thanks again for your time, Hemal. Appreciate you educating everyone and teaching us a little bit about multifamily. Hope you all on the call enjoyed that. That was super educational and super informative. So that's it. Have a great rest of your day, everyone. And
thank you, everyone. Thanks for your time. Thanks, Cliff. Take care.
Okay, take care, everyone. Bye.
Bye.